China and Russia haven't just resisted the US dollar. They've slammed the door and tossed the key. Not in theory. Not in the distant future. Right now, as you read this, oil, minerals, microchips, the raw essentials of the modern world, are changing hands without a single dollar involved. Rubles. That's the new reality. Quietly but decisively, Beijing and Moscow have rewritten the global trade playbook. And while Washington still demands that China open its markets, American exporters are already bleeding. Small businesses are cracking. Collapse isn't looming, it's underway. Behind the curtain, Asian central banks sit atop $2.5 trillion in U.S. assets. It's a ticking time bomb, liquid, mobile, and just one political decision away from going off. Trump calls tariffs leverage. But what if they're not? What if these tariffs aren't a bargaining chip, but a boomerang, a weapon turned inward, aimed straight at the American economy? Wall Street is already trembling. For millions of workers and small business owners across the country, these tremors are just the beginning. Because how do you demand access to someone else's door while bolting your own shut from the inside? That's the contradiction at the core of this strategy. The U.S. wants China to open wider, more access, more sales, more opportunity for American firms. Yet we're simultaneously building a tariff wall so high, 145% in some cases, that it's choking off Chinese imports. This isn't abstract policy debate. It's a direct blow to the real economy. By May 2025, importers had to charge $18 just to break even on products that used to sell for $10. The math doesn't work anymore. The system is cracking. Washington's spin machine voices like Scott Bassett frame this as tough love, pain now, better deal later. But what deal are we even offering? The White House keeps demanding more while giving less. Meanwhile, U.S. exports to China still pull in over $140 billion a year and support 500,000 American jobs. That's not leverage being used. It's leverage being wasted. And here's the deeper absurdity. If China's market, 1.4 billion consumers, is so vital to our economy, why are we making our products more expensive, slower to move, and harder to sell? It's like trying to climb while sawing off your own ladder. At America's biggest ports, Los Angeles, Long Beach, the impact is visible. Container traffic from Asia has plunged nearly 40% year over year. Washington calls this a win. Tariffs are working, they say. But they're only looking at half the story. China hasn't stopped exporting, it's just found new buyers. April 2025 trade data shows exports to the U.S. dropped 20%. But China's global exports rose 8.1%. Southeast Asia picked up the slack. China's exports are thriving elsewhere while drying up here. This isn't coincidence. It's a rewired supply chain strategy that's been quietly in motion since 2023. The U.S. tried to freeze China out. Beijing simply recalibrated. The factories didn't stop. They just shifted direction. So, who's really getting shut out? China didn't rage or retaliate in headlines. It quietly raised tariffs on U.S. goods to 125%, pivoted focus, and let the numbers tell the story. The result: U.S. exports to China are in freefall. Corporate giants like Apple, McDonald's, and Starbucks are losing ground. Luckin Coffee is beating Starbucks in top-tier cities. Huawei is pummeling iPhone sales. American companies earned $1.2 trillion in China last year, 4 times the size of our trade deficit. That market isn't just important, it's irreplaceable. And it's slipping away. If this keeps going, we won't just be losing revenue, we'll be losing relevance. Brands that once symbolized aspiration are fading into afterthoughts. The stakes are rising fast. Can U.S. exporters survive this freeze-out? Or is China quietly walling off the future? Here's where it turns critical. Washington sees falling shipping numbers and calls it progress. They believe the pressure campaign is working. But what if it's not pressure at all? What if this is self-inflicted damage? In May 2025, Scott Bassett met with Chinese officials in Switzerland. Trump called it a great meeting. The result? No deal. No agreement. No progress. Just silence. Meanwhile, the pain at home is deafening. Small businesses across the country are falling apart. From a toy manufacturer in Massachusetts to a floral supplier in Kentucky, the story is the same. Canceled orders, stranded shipments, cost exploding. WS Game, a mid-size manufacturer, has already lost $16 million in sales. $500,000 worth of goods are sitting stuck in China. And they're not alone. There are hundreds thousands like them. If this is what strategy looks like, it's one that ignores the smoke pouring from our own engine. Supply chains are snapping. Exporters are gasping. Ports are falling silent. This isn't leverage. It's damage. And the other side isn't blinking, because while the U.S. tries to win a game of pressure, China and Russia have already moved on. They've built a new game entirely. In a quiet but historic joint declaration this spring, they announced that nearly all of their bilateral trade, oil, gas, minerals, and other industrial lifelines, will now be settled in rubles and yuan. No dollars. No dependency. Their goal: build a system immune to third-party interference. That's code for sanctions. Code for cutting out dollar dominance. And while Washington debates tariffs and brags about tough deals on social media, the rest of the world is adjusting. Realignments are happening. New alliances are forming. Trade is moving, just not through us. The world isn't waiting. And if we don't wake up, we won't just lose this round, we'll lose the future. China now conducts over half of its global trade without touching the US dollar. According to recent SWIFT data, yuan-based transactions have climbed from just 2% in 2021 to over 4.3% by early 2025. But this isn't just about percentages. It's a shift in trust. The dollar's strength rests entirely on global confidence, and that confidence is slipping. Beijing and Moscow are building a parallel global trade system, one that bypasses Washington entirely, and with it the dollar. This isn't a future scenario. It's unfolding now. As the U.S. scrambles to regain leverage, it's at risk of losing the very foundation that underpins its financial dominance. Beneath the dollar lies a ticking time bomb. $2.5 trillion in dollar reserves quietly accumulated since 2020 by exporters in China, Taiwan, Vietnam, and Malaysia. That mountain of reserves is now unstable. After U.S.-Taiwan trade talks, the Taiwan dollar spiked 8% in just 48 hours, its sharpest jump since 2007, triggering a wave of gains across Asian currencies. In response, the ICE dollar index plunged 9% in 2025. Traders braced for what analyst Stephen Jen warned could be a nonlinear sell-off, a scenario where multiple countries rush to dump dollars simultaneously, unwilling to hold a rapidly weakening asset. This isn't speculative currency chatter. It's a sign of deep structural risk. With the Federal Reserve expected to slash interest rates by 75 basis points this year and dollar-denominated assets already overvalued, Asian central banks now face a brutal choice: quietly unwind their dollar positions or get caught in a chaotic sell-off. Either path could reshape America's place in global finance. And the pain is already being felt at home. In Massachusetts, WSGMO had $500,000 worth of goods trapped in Chinese ports and lost $16 million in domestic retail contracts in just one quarter. In Oklahoma, 4K9 was forced to halt imports of its best-selling dog seat covers due to tariffs, despite rising demand. In Michigan, Lisa McDonald's specialty tea shop, which relies on premium Chinese imports, is now weeks away from pricing itself out of business. These aren't global corporations with diversified supply chains. They're small American businesses, lean, local, and resilient, now being crushed by policy decisions that ignore their reality. Trump's tariff regime hits these firms hardest. While multinationals can shift production across borders, small and mid-sized businesses are locked into sourcing networks they've built over decades. Officials still insist America is the world's top destination for capital, but on the ground, mom-and-pop shops are crumbling long before investors take notice. And even if a trade deal emerges, tariffs are here to stay. White House economic advisors are pushing for a permanent 10% baseline tariff on all imports, even from allies. That doesn't just hit adversaries. It embeds new costs into every step of the U.S. supply chain. According to the KE Institute, this policy could lead to a 17% drop in U.S. exports, forcing American producers to absorb painful losses or surrender global market share. Meanwhile, China and its trade partners expect only a 5% decline, manageable due to leaner margins and more flexible cost structures. The irony is staggering. The country pushing hardest for trade realignment is actively making its own goods less competitive. Tariffs are inflating prices across the board, from components to finished electronics, squeezing the very industries they're supposed to protect. This may no longer be a battle over economics, but one of appearances, signaling toughness at any cost. But if China starts pulling back on U.S. goods, Wall Street could be next. And so could the dollar. In 2024 alone, the U.S. exported over $140 billion in goods and $46 billion in services to China, supporting nearly 900,000 American jobs. California accounted for $15 billion of that, Texas over $21 billion. But exports aren't the biggest risk, capital markets are. According to S&P Global, U.S. companies earn 7% of their annual revenue from China. Lose that, and forecasts evaporate, dividends falter, and investor confidence erodes. And when Wall Street bleeds, the dollar stumbles. The world's demand for U.S. stocks and treasuries is rooted in trust in stability and growth. Cut off access to China's massive consumer base, and you don't just shake earnings. You shake the very foundations of the U.S. financial system. Investors don't wait for official statements. They move at the first sign of smoke. So here's the question. Can the U.S. maintain dollar dominance while pushing away its largest trading partner? This isn't just a tariff war. It's the unraveling of the post-1990s global trade order. China has rerouted exports, decoupled from dollar flows, and doubled down on yuan settlements. Russia has left the dollar system entirely. Export-driven economies across Asia are now preparing for a broader dollar retreat. And while U.S. officials insist the market remains open, the tariff wall tells a different story. Small businesses are collapsing. Wall Street is exposed. And the dollar is growing unstable, all under the weight of policies that sound strong but may be dangerously brittle. If the dollar is no longer the world's anchor, does the U.S. still anchor global power? And what happens to every investment, business loan, or retirement account built on the idea that the dollar will always win? The foundation is shifting. The only question now is who falls?